$4.6 billion, gone in a matter of weeks. The men who lost it weren't reckless. They had elegant, highly sophisticated models. Their names were Myron Scholes and Robert Merton. They had a Nobel Prize, one specifically for figuring out how financial markets actually work. Meanwhile, a few states away, another man was getting obscenely rich doing almost nothing at all. He bought boring companies, ignored the news, and took a lot of naps. His name is Warren Buffett. Now meet Henry. He's sharp, he reads the financial news every morning, and over the course of his life, he will walk straight into the exact same traps that swallowed the Nobel laureates. This is the genius tax. In investing, the harder you try to outsmart the market, the more certain you are to underperform it. Waiting for a dip or getting out before a crash feels like the responsible, smart move, but trying to dodge the bad days by pulling your money out quietly ruins your decades of returns. This chart tracks a volatile market timeline. The market does most of its work on a tiny handful of explosive days, and those days hide right next to the terrifying ones. 7 of the 10 best days happen within 2 weeks of the 10 worst days. The exact moment you panic and run for the exit is usually 2 minutes before the rebound you needed was about to pay you. Then there's the cost of paying an expert to navigate all of this for you. An actively managed fund often charges a 2% fee. It acts like a silent roommate, skimming off the top year after year without paying rent or doing dishes. Over a 30-year timeline, that 2% fee consumes nearly half of your final nest egg. It effectively transfers a full decade of your working life to a fund manager, money you earned but will never see. Frenetic trading and paying expensive experts feels like taking control of your future. Mathematically, it is a machine designed to make Wall Street rich instead of you. Smart people also routinely step outside their boundaries. They confuse using a product every day with understanding the business model, its debt, its margins, and what a rival could do to steal its customers. The Nobel laureates from 1998 had models that were, on paper, low risk. To turn those careful edges into big returns, they stepped out of careful analysis and started borrowing heavily. This diagram breaks down how 25-to-1 leverage works. For every real dollar they had, they borrowed 24. At that ratio, a perfectly normal 4% fall at the top drops straight down and completely erases their 100% equity base at the bottom. Borrowing money steals the one weapon an investor actually needs, the ability to wait. They faced a margin call, forcing them to sell at the bottom. It took a $3.6 billion rescue organized by the Federal Reserve to stop the whole system from going down with them. Intellectual brilliance offers zero protection if your ego pushes you to risk money you actually need, chasing extra margin you don't understand. The market flashes prices all day, but price and value are completely different things. Price is a number driven by the crowd's daily moods and fears. Value is the actual cash a working business throws off over its life. When you ignore value and follow the safety of the crowd, you get trapped. Millions of everyday people bought speculative tech companies in the late 90s, not because they analyzed the underlying cash flows, but because the crowd was roaring and the lines were going up. When those prices inevitably drop, pride kicks in. People keep shoveling money into dying companies just to lower their average entry price, confusing a cheaper price tag with a better value. Obsessing over a daily price tag divorces you from the reality of the business. You stop investing and start playing an emotional guessing game driven by group chat momentum. The hardest part of true compounding is the boredom. For the first 10 or 15 years, the growth of a solid investment looks completely flat and almost insulting. This compounding curve stays remarkably flat for years. Over 60% of wealth shows up in the final decade. Selling a winning stock early to lock in profit amputates this exact curve right before it goes vertical, handing decades of growth to the next buyer. Because of the fear of losing money, people hide their savings in cash, but cash shrinks every single year. Inflation is a tax nobody votes for that silently eats your purchasing power, leaving the face value intact while destroying what it can actually buy. Parking your long-term wealth in cash guarantees a slow, invisible loss. Doing nothing with a great compounding asset is the hardest, most profitable move in finance. Henry eventually stopped frantic trading. He stopped paying the high fees, sold random stocks he couldn't explain, and quietly moved his money into a simple, low-cost index fund. Buffett's partner, Charlie Munger, summed up the philosophy. The goal of long-term wealth building isn't to be highly intelligent, it's to be consistently not stupid. Escaping the genius tax requires humility and temperament, rather than a high IQ. You simply need to let time do the heavy lifting, while everyone else outsmarts themselves.